markets. This is actually the third update that we're having, probably in as many third update we're having in as many weeks, because we've been on a downturn for the past 1 month, and this is the third one. This is actually to try and update clients and also prospects on our thinking behind the COVID-19. Okay, yeah. Let me just get to the housekeeping. I heard someone coughing there. Yeah. Okay. Please remember to mute your microphone. Some of you who are new to this GoToMeeting, there is a button there to actually mute your microphone. Please ensure that your webcam is off. We had one internal meeting with our consultants, and we had one consultant eating her sandwich in front of the webcam, and she forgot to switch off the webcam so everybody could actually see what she was eating. So anyway, we'll have a Q&A after this. The Q&A, you'll be able to use the chat message box, which I think you can see there. You can type in your message, your questions, and I'll answer it based on the questions on the chat message box. Okay. Otherwise, just a little bit of disclaimer. Usual, whatever is being expressed here is not expressed as an advice to buy anything and to invest in anything. Please get the advice from your own respective financial advisor. This is for education purpose only. Okay. All right. Let's start. Okay, I'll call up as usual the laser pointer. Okay, in the previous session, which was held about 10 days ago, this was one of the charts or slides that I put up. Back then, we were about here. We were saying, or rather, our view has always been, that the markets was coming down, but it will reach a point where the markets actually will move sideways in a consolidation. I always tell people that markets don't go up in one direction, in one straight line. They always pause, and in the same manner, when markets go down, they don't go down in one straight line, but at a point there will be a pause. And I think we've reached that pause, and I'll try and explain why I think we've reached that pause temporarily. Back then, what I said was we would probably see a COVID-19 bottom, and I think we've reached that bottom. Okay, and that bottom was probably reached March 23rd, where the market actually did a bottom and is off that bottom at the current time. The consolidation may last a few weeks. I'm not sure. We'll have to see the market price patterns and stuff like that. But I think the market is probably quite done or finished with discounting the bad news. Now it's looking to discount some of the good news. Good news continues to come in terms of the fiscal and monetary policy that's being supportive and so on and so forth. So basically, that's now being discounted. A lot of bad news has been discounted. Now it's turned for the good news, and that's what's causing more of a two-way situation and a bottom being created. So we think a temporary bottom may be in place. This is an S&P 500 15-minute chart. It's easier to decipher the price patterns when you use a smaller chart. And a 15-minute chart is, of course, a smaller one compared to a daily chart or even an hourly chart. Way back on March 16, when we did the previous update, we were here. Market has then come down a little bit more, but on March 23rd, it bottom roughly at about 21.92. This is on the S&P. I think other indices may look roughly the same. Okay, and then after that, it did quite a strong rally. This is today, in fact. I think just a couple of hours ago, it's come down. Or this is last night. Came down a little bit. Now the futures are showing about a 1% decline on the S&P, or slightly less than 1% decline. Okay, but it still hasn't threatened the bottom yet. So what I see going forward is, if you look at this and you apply a little bit of technical analysis, you could actually draw a kind of a small little minor trend line, they call it. It's broken that. If you draw another trend line here, a more major one, then therefore you can actually start setting what we call the resistance level. We can set another 2 more resistance level by saying, if this whole decline here retrace back up again, it could retrace in what we call the Fibonacci, 38%, 50%. So all in all, this retracement would probably find very strong resistance at about 660, 2800, meaning to say there could be another 10% upside from here. And yet it's still, if we believe that it's a downtrend, it's still within a downtrend. These are very normal kind of bounces of a downtrend. You know, like I mentioned earlier, markets don't go down in a straight line. There's always what we call a rebound and so on and so forth. On the bottom side is 2192. So don't be surprised if we start to see maybe what we call a consolidation within this particular range itself. Okay, so that currently is the thinking, and I think visibility-wise, that's the visibility that I have over the next at least 1, 2, maybe even up to 3 weeks going forward. So I did mention a few times, I think the market has really more or less discounted the COVID-19 situation. I think, again, it may be very difficult for some people to comprehend this, because as you look at the numbers, it continues to go higher. You look at the death rate, it continues to go higher. It's doubling in the US every couple of days. So, you know, but I want to remind everybody that the market is different from reality. The market tends to discount things. I've mentioned it before. I have a short video which I'll give you more or less later on where to find it. I mentioned before that the market, in my view, will actually look at this curve. It's called an epidemic curve. So the current epidemic curve, if I bring everything up, this was also brought. I mentioned this in the previous session. China's epidemic curve has come to an end, but the world's epidemic curve is actually now on an uptrend, and we will see sharp rises over the next 1 to 3 months. I've seen a few reports where analysts have said you can't buy into this market until you see the curve peak, or at least you see the case counts come down. I don't think that will be the case. I mean, I could be wrong, but I don't think that will be the case. I think markets will actually bottom out temporarily, even before we reach the peak, because again, market is a discounting machine. It actually discounts the future. It doesn't wait until things happen. Whatever news it knows, it learns, knowledge it has, it then discounts what is going to be expected in the near future. So I think markets at this particular point has more or less discounted COVID-19, because it knows going into the future, it will peak and it will come down. If you look at the latest epidemiological curve, and this is given by the European CDC, I do encourage you to go to the website. It's also quite good, a lot of information there. Basically, this is the China case count, and this is the worldwide case count. Very similar to what I showed you just now in terms of the first hum and then the big second hum. Virus, the epidemic curve, so-called, for viruses are quite predictable. It's a bell curve. So basically, as we go along the bell curve, one thing is quite certain. Once we move along here, we know that the end is near, or rather we could see the end of the light at the end of the tunnel. And I think the market will bottom out, or probably has bottomed out, because it's discounting the light at the end of the tunnel. So if I take the European CDC curve and I put it somewhere along a line here, okay, what you'll see is I think it may have actually moved up to about maybe 1/5 or maybe 1/3 of the curve. I'm not sure how this curve will be, because it really depends on the measures taken. You know, people are talking about the flattening of the curve and so on. So maybe this is really a guesstimate. Yeah, so it could actually be lower than this, it could be higher than this, we don't know. But I'll just, you know, put my neck out and say that we're probably about 1/5 or even 1/3 of the way. But importantly, I think the market knows that we will peak somewhere in the next few months. In fact, the Financial Times had a report, and the report quoted the Imperial College, a report done by the Imperial College. So Imperial College is a very famous medical college there's a famous medical college in the UK. They came out with a report which both the UK government and the US government relied upon quite intensively. Especially the UK government. If you all remember, the UK government, when they first started out with its strategy with regards to COVID-19, adopted a strategy called herd immunity. It wanted everybody to just get the virus so that the majority of people would actually have immunity very quickly, you know, and then you wouldn't have to worry too much about having to close down schools, so on and so forth. But after reading this report, the UK government realized that if nothing was done, and these curves are based on nothing that's done, if the governments don't do anything, up to 500,000 people, mainly the elderly, those people with pre-existing illness in the UK would die. And in the US, it would actually be 2.2. So basically, you had Boris Johnson, you had possibly President Trump being advised and say, look, if you don't do anything, if you adopt this kind of layback attitude towards this virus, these are the numbers that will crop up. And of course, these two numbers are not very good in terms of, voters and stuff like that from the political perspective. So again, that has actually spurred both governments to act differently from what they initially had done. But the key thing about the report, if you look at the epidemic curve here that they've put out, is two things. One is, if nothing was done, then the peaks would actually come roughly in June, maybe late June, yeah. And the whole cycle for this virus would actually come to an end, meaning to say that you'll see the case count drop roughly in about August. Yeah, so you can see from there that the scientific community, people who study this virus, they know, and it's very obvious when this whole first wave, they call it the first wave will come to an end, and that's basically in July or August. So again, from the market perspective, the market is smart enough to look at this and say, in all likelihood, things are going to peak out in June, July, and come to an end maybe in late July, August. Yeah, so we will act way before that, because as usual, markets don't wait for the event to happen. Markets act ahead of the event. And the second thing that has caused market to bottom, apart from the fact that I think the market has fully discounted the coronavirus, is the Fed's move to shock and awe the market. I won't go into all the measures that the Fed introduced and so on and so forth. It's just a whole list of measures. Sorry. But if you look at basically the headlines, it will tell you basically that the Fed really surprised the markets. I read analyst reports, a lot of analyst reports, and a lot of them say we did not expect this. This is really way beyond. In a nutshell, what the Federal Reserve introduced were two sets of measures roughly. One was measures which were already introduced way back in 2008, but this time around it came in much bigger than 2008. Another set of measures which were not introduced in 2008, totally new measures, and these measures now supplement the so-called bigger 2008 measures. So you had really these two layers of measures coming in, so much so that it was really quite a positive shock to a lot of people in the markets. In fact, if you see what David Rosenberg said, and David Rosenberg, I think, former Morgan Stanley chief economist for the US, he said that, in the 2008 crisis, it took about 8 months for the Federal Reserve to introduce about 15 actions or do 15 types of actions during the crisis itself of 2008. Today, those 15 measures were all came at the same time, all within 1 month, and basically all within a week, because the Federal Reserve just came out with everything about 10 days ago, and they have been introducing measures after measures after measures after measures. Yeah, so basically, the Federal Reserve, upon seeing and knowing what's going to happen to the economy, decided that really we need to come out and shock and awe the markets. The key one, which I think really put a flaw under the markets, was the fact that they announced QE infinity, basically saying we'll do anything. If we need to print, we will print. There is no such thing as 500 billion, 700 billion. This is an open checkbook. We'll print until we can support the economy, we can support markets from freezing up. So basically, this was the one I think that actually really put a flaw under the market temporarily, albeit. Okay, the central bank actually has also shifted in many cases, and I'll tell you why in a while's time, from just being a lender to now being a buyer. So typically, central banks don't move to the buy side. They don't buy. They don't become the market. One thing that you don't want the central bank to be is both a seller and buyer in the market, a bid and offerer in the market, a bidder and offerer in the market. I mean, central bank is not supposed to be the market. Central bank is supposed to ensure that the market moves smoothly, but not be participating in the market. However, this time around, the central bank felt it had to participate in the markets because global markets, especially the US, has started to freeze up. Everywhere you look, you will see headlines of market freezing. Even in late February, you see that actually the market volume had basically just evaporated in the US and Europe, and this thing was even worse in early March, in the first 2 weeks of March. So I think that actually prompted the Federal Reserve to come out and introduce this shock and awe, because it really needed to restart the global financial markets, especially the credit markets. In fact, there were bankers who actually was trying to lobby Washington to actually close the markets because things were getting so bad. And just to give you another example, you know, in Malaysia itself, I spoke to a consultant who said that his client who was holding some bonds wanted to sell the bonds. There were no bids. There was basically no bids in the market in order, even if you wanted to sell. And that's really what summarizes a freezing up of markets. Typically, no bonds, no bids itself. So Federal Reserve, in this example, would come in and become the buyer of the bond. So basically ensuring that the credit market doesn't freeze up. Yeah. So basically that's just an example. The US, I think it's now the stimulus plan is being put through the works. I think it's going to go to the House if I'm not wrong. Yeah. In part of the stimulus plan, just to let you know, put an asterisk there because this was one part which caught my eye in the so-called all the measures in the stimulus plan, is that there's going to be a ban on companies that take government loans from buying back their own stocks if they take the loans from the stimulus plan. And I can assure you that there will be a lot of companies who will be taking the financial assistance being given by the stimulus plan. The stimulus plan is already said that it's going to give to the airlines, it's going to give to the SMEs, it's going to give to basically every sector, of course more heavily to the sectors being affected, tourism, airline, and so on and so forth. But I think everybody will take those loans. And in doing so, you will not be able, if you're that company, if you're a public listed company, to buy back your own stocks for a year after the loan is paid back. Okay, and this is important because why I brought this up before, the only thing that has actually been propelling the S&P 500 and Wall Street higher over the past 10 years has been stock buybacks. If you look at this chart itself, you look at institutions, household, rest of the world, which is all these lines lumped here. Sometimes they're positive, sometimes they're negative, sometimes they're even in negative territory throughout. The only thing that has been going up higher and higher and higher is non-financial corporations buying back their own shares, which is the Apples, the Netflix, the Microsofts, all these people share buyback, basically the Xerox and so on. So they buy back their own shares because why? Because they can manage to finance it by issuing bonds, getting cheap money. Money was actually very cheap. Interest rate was very low. The bond market was very vibrant. So they issued all this and basically started to buy back their own shares, causing their shares to actually move higher and higher and higher. So this was the main thing that's been causing Wall Street to go higher and higher and higher. And if you look at this correlation chart, which we did, it basically shows that both the correlation between stock buybacks and the movement in the S&P in terms of first derivative, which is a percentage change, it's almost very strong correlation. So basically, when you take that away and assuming everybody takes these government loans because of the situation, you are basically taking the strongest boost to the, at least to Wall Street, away from the markets. Yeah? So I thought this was an interesting fact. Okay, so basically, big question here is what has market discounted? I think this drives our thinking very much as to the situation in the market. Those of you who have been following the update number 1, update number 2, you will know what I'm talking about. Meaning to say that at this particular point, this huge decline here, which we kind of forecasted because we said the market has totally wrongly discounted the fact that COVID-19 is going to look like SARS. It's not. It's going to spread. It's going to go to every part of the world. There are going to be shutdowns everywhere. Market did not realize it, and when market realized it, market actually fell. Then of course there was some a rebound there. And the second part here was when the markets then realized things are just so bad, credit markets then started to freeze, and of course there will continue to be worries about COVID-19 and stuff, and the market started to fall. And then the market started to incorporate what we call the economic realization of how things could be, because now that we're shut, and when you totally shut down, in the case, for example, in Malaysia, 14 days initially, then it's added on another 14 days. And then, you know, it could just go on to another 14 days, because until you get the epidemic curve peaking and coming down, it's very hard to release people back into the open, into the public space. Because once you do a shutdown, you're not going to release and lift that shutdown until things improve. So you're talking about potentially even a 6 weeks to 8 weeks kind of shutdown. And people in Wuhan, for example, continue to be in lockdown mode even after 2.5 months. Yeah, so again, this kind of situation now made people realize that actually the economic consequences is quite large. Okay, so we got this whole thing here, everything, all three things being discounted at one time. Then the monetary measures came in, then the fiscal measures came in, and finally, like I mentioned, as the negative side got discounted, then the positive side came in, and now because we are discounting the positive side of it, we have this market rebound. So a big thing now is to ask ourselves, as I mentioned, over the next 2-3 weeks, we'll probably see market moving higher. We probably see market moving in a range as it starts to build a base. The big question now is it going to move up from here, or is it going to move down? The big, how do we answer that question? We answer it by asking ourselves, is there anything that the market has missed out on? Because it's discounted a lot, I do admit. It's discounted a lot of the bad news. Is there anything else that is missed out on? That would actually help us to answer whether the markets are going to go higher from here or the markets will turn down after a while. So when I see some of the things being spoken about, the Bank of America, for example, and of course every house on Wall Street is saying, you know, the obvious, a recession is coming. I believe a recession is already here. I think increasingly more and more people are already. I think Singapore released its numbers. We are in a recession in 2020. It's going to be written off as a recession. Jobs will be lost. Wealth will be destroyed. It's the obvious. So basically, it's the same old playbook. The authorities, the central banks, both Bernanke, Fed's Bullard, all say the same thing. The economy, they're looking for a V-shaped recovery. When you say we're going to a recession, yes, it's going to be deep, it's going to be hard, but given the measures that we've introduced, it's going to rebound back again. So it's based on the 2008 playbook. Bad recession, throw money at it, lower interest rates, it will rebound back quite sharply. Okay, so that tells me that actually if you think that this situation can be solved by what we call the 2008 playbook, then I'm fine. Then I'll say that the markets will move up from here. But I don't think that's the case for two reasons. Reason number one is I think that there's a high possibility that the market has really underestimated the severity of the economic impact of COVID-19, meaning to say that, you know, we're talking about closures, quarantines of not only communities but whole countries, and we're talking about not just regional. You know, sometimes you talk about the 1997 Asian crisis. It was Asia, and maybe Russia, but you still had the US chugging along quite well. You had Europe chugging along quite well. When you had the US crisis in 2000, the dot-com, it was mainly US, centered in the US, and everybody else was doing quite well. Even China was doing quite well back then in the year 2000, and that was when China and India saved the world, according to many people. In 2008, it was a little bit more global in a sense, but it didn't cause what we call a total shutdown itself. This current crisis, I mean, there is no way you can model it, because in my view, we've never come across a situation where not only countries have shut down, but it is actually across the globe. You know, we have a total shutdown of the global economy. I mean, that sentence by itself is quite shocking, but you and I understand what I'm talking about because we see it with our own eyes. So to say that we are going to get a V-shaped recovery is to use an old playbook and put it now where this has never. I don't know how economists and strategists are going to model this, because to me, you can't model something which you've never seen before. It's just so difficult. You can try, but I think the numbers are just going to be so bad. So I think that's one thing which current regulators and central bankers, and I think they may have also missed. I mean, I don't blame them. It's very difficult, but I think this is one thing which the market really hasn't actually. So when we start to see the defaults, when we start to see the companies, the jobless rates and stuff like that, again, it's very difficult to model certain things, especially also when it's cross-border. We found out this in 2008. In 2008, people were trying to model how an impact in the US would actually permeate over to the rest of the world. These things became very confusing because there are a lot of linkages that models, you have to build it in, because models are basically what you build in. And people couldn't sometimes find out if something happened here, what was the second effect, third effect, fourth effect into something else. So it's difficult. And now we're talking about something which is global. So again, I think there could be a risk of an underestimation of the impact, global economic impact of COVID-19 on this, and all the dominoes. I've mentioned previously about dominoes, what happens to your triple B bonds when they start to get downgraded, what happens to your junk bonds, what happens to your ETFs, and so on and so forth. So all these things, again, could just make things much more far worse than we think it is. Okay, so that's number one. Number two, which I think is something which the market may be totally missing out on, is the question of when will life return to normal. I think people are looking at a V-shaped recovery, thinking that after we pass, they look at the epidemic curve and they say things are going to end in June or July. Okay, we could see some spillover. So the second half, things are just going to go back to normal, but because it's the decline was so deep in the first half, the second half is not going to make up for the first half. So therefore, we're still going to get a recession. But guess what? Things are just going to be chugging along back to normal in the second half. Therefore, 2021, things are going to be okay. I have a feeling people are looking at it that way, especially when people say it's going to be a V-shaped recovery. I'm telling you, it's not. When you look at Singapore, and I think this is one of the ministers, Balakrishna, he said that the coronavirus outbreak and its economic aftermath will last at least a year. I know some people actually scratch their head and say, why is he talking about a year? And I think the Singapore government is smart, because they realize that actually this thing won't go away until you actually find a vaccine. We've heard a lot of reports about people finding a vaccine for COVID-19, but I think a lot of people fail to realize that when you discover a vaccine, you still need to put it through many different types of tests. You know, in the lab, then you do the test with the animals, then you do the human ones, and then you start off with actually just one individual first, then you open up the group into a dozen, and then you open it up into really a couple of hundred people. And in any point in time, if one of these things, in one of these kind of groups, something goes wrong, you go back to square one. So just the discovery of a vaccine itself isn't the solution. It still has to go through this whole process in order to then after you discover and everything, even if it's a go ahead, you need to ramp up production, and production takes months. And if you're talking about the whole world, about 7 billion people, you're really talking about, you know, by the time everybody gets an injection, it would be months and years, probably years from now. So all estimates that I've read about from credible people who know the markets and who know this thing about creating vaccines, everybody says it's 12 months to 18 months. Imperial College of London is in its report. It is estimated it will take 18 months to find a vaccine. Okay, so I'm saying, what I'm trying to say here is, even if the epidemic curve ends in August and maybe 20-30% of the world is infected, there still will be about 50, 60, 70% of the world who is unaffected, uninfected, or people uninfected. Okay, it could be lower, it could be higher, we're not sure, but there could be a big group of people who just did not get the infection. And yet the virus is still in the community. So we will still get what we call outbreaks here and there. We will still get what we call quarantines here and there. It may not be as massive as what we see now, but there will still be. So basically, you and I, for example, if we don't get infected in this first wave, even if the epidemic curve comes down, I'm going to ask you a question. Are you willing then to resume life as normal, to hop onto a plane, not knowing whether the guy next to you has the virus because it's still around, not knowing whether if you enter a movie theater that the person sitting next to you, not knowing if you enter a restaurant, the person next to you, the waiter, and so on. So what I'm saying is, as long as we don't have a vaccine, I think life will not return to normal. So what will happen is there will be this social distancing, there will be a hesitation to just continue as per normal post COVID-19, December 31st, 2019, what the life we saw before that is not going to be the same after. Okay, so you see, for example, some pictures which I've taken. This is actually in a factory in I think Wuhan or in China, a car factory. This is how they have their lunches nowadays. Yeah, all separate because there's social distancing. This below here on the bottom right, this is a place which I went to, Suntec City, one of the outlets. Again, social distancing. I think we see it now everywhere. This is in the movie theaters now in Singapore. If you want to go and book a ticket, basically you're not going to be able to sit. If you're 4 people or 3 people, you're not going to be able to sit together because it's social distancing. And this is, of course, quite sadly, Changi Airport, whereby all the planes have been grounded. Some airlines have totally grounded everything. I think Emirates have done everything. I think there's still some flights with regards to SIA and stuff because people are not traveling. So when we pass the epidemic curve or when we kind of go all the way down in August, September, October, November, December, 2021, January, February, March, when there's still no vaccine, are we going to resume life as normal, or are we still going to be quite cautious? I think we're going to still be quite cautious. Yes, of course, the hospital beds will be available if you fall sick and stuff, but merely looking at how COVID-19, some videos coming out, how people are suffering, they don't die, but the pneumonia, the breathlessness, you really just don't feel like I don't want to get this, so I'm going to play safe. So I think a lot of things will change. When you talk about social distancing, just imagine, just take the example of a movie theater. It used to be that you could sit 100 people in one sitting. And now because of social distancing, even if you fill that movie theater with everybody that you can, it's going to be 50% or less. So you talk about revenues, earnings of companies being cut regardless. If people feel that they want to go back in again, that's fine. But it's still, because of social distancing, it's going to be halved. Travel and everything, I think people are just going to scale back on that until, we get a vaccine. So it's not going to be life back to normal, and I think the market really hasn't discounted this yet. So I think basically after the adrenaline wears off, meaning to say that now we're all excited about QE Infinity, the measures, the packages, and so on and so forth. But when reality seeps in, I don't think it's going to be business as usual. I think until we get a vaccine, it's going to be business unusual. Means to say we're going to operate in an environment which is very unusual but necessary, and already we are adapting to that environment now. Okay, one thing we could actually see is a re-rating of markets. And what do I mean by a re-rating of market? We used to think that markets, for example, in the S&P 500, 17 PE, which is price earning, was basically the fair value of markets. If markets went up to 19, 20, they were expensive. Market went down. If the market goes down to about 14 PE, 13 PE, was really cheap time to buy. And 17 was the average. And what does 17 PE mean? 17 PE means you're willing to pay $17 in order to buy one portion of profits. Okay, 1 unit of profits. That's what it means. And that's when the situation is normal. Okay, what I think will happen is we could actually see markets re-rated lower, to say something like, now the normal average market is actually about 14 PE. So now that low end that was previously the low end, that could be the new norm now for average. Okay, so basically why? Because companies are not making revenue as much as they did, because people are not going and spending and so on and so forth. Like I mentioned, social distancing. So basically you get a re-rating of the PE of either industries. Maybe the airline industry's PE will be re-rated much lower. but others will be re-rated but not as low, but still re-rated. You get that because of lower earnings, because of lower expectation, your PEs get re-rated and your averages are lower. Automatically, prices will have to come down to reflect lower PEs for certain industries and for the market as a whole. So basically, we could get market coming down, stabilizing, but not going back to their normal levels. Because why? Because the market averages is now no longer 17 PE. The market averages is now 14 PE, for example. That's what I call re-rating. So I think that could happen in my view. And that would actually be something that the market currently today may not have actually anticipated or priced in totally yet. Okay, so not a long one. I think about half an hour or slightly more today. I just wanted to tell you more or less the thinking. And again, these sessions are not meant to last very long. It's just a very quick update, and then for you to ask questions. We posted a few more YouTube episodes. Please go and subscribe to our YouTube. We have the latest one is talking about how certain asset markets have done in Singapore, and also there's one about the bottoming of this thing which I've just told you about. Okay, so please do subscribe to our YouTube. What I'll do now is I will open up the segment to Q&A, and you can actually start posting your questions on the chat box, and then I will pick it up from there to answer your questions. Okay, first question. As mentioned in the previous session, you think US wants to see US dollar weakening moving forward. Can you further explain on this? Yes, okay. You see, whenever a currency, one of the ways to actually stimulate an economy is actually to have a weaker currency. I mean, that helps in terms of exports. So basically, you could three things, the three measures. One is fiscal policy in a recession to, of course, do fiscal policy. Two is lowering or rather loosening your monetary policy, and three is to weaken your currency. So all these three things actually help in a recession. Because the US currency is just so strong, I think that's a dampener and it offsets some of the fiscal and monetary policy that the US is doing. This strengthening of the US dollar is a bit technical in nature, meaning to say that people were rushing for US dollars because I mentioned last time 60-70% of world trade still continues to be in US dollars. So people actually were hoarding, not toilet paper, but hoarding US dollars. They were keeping US dollars because they were afraid that it may get more expensive to buy US dollars and stuff. So basically, we had reports, I've read reports of corporations drawing down on their credit lines. It means money they don't need now, but they just drew down on US dollars to keep on to it in case they needed it. So that caused the US dollars actually to spike up sharply. The Federal Reserve has now come out to do swap lines. Swap lines means they work together with other central banks like Bank Negara, Bank of England. If you need US dollars, come, you give me your British pound, I'll give you US dollars. So to ensure that in the British system, there's enough US dollars. So they are actually trying now to cap the US dollar strength by introducing these kind of swap lines. This is nothing new. In previous episodes of US dollar strength, the Federal Reserve has historically come in to introduce swap lines and also certain direct intervention to try and cap US dollar strength. So it's really something which they've done before. Okay. The YouTube channel's name is called Financial Alliance. Just type in Financial Alliance, you see our logo, and that's our YouTube channel. What's your opinion on the stimulus of 2.2 trillion, and has it already been factored into the market? Market has really begun since the beginning of the week. Yes, I think the stimulus is good in the sense that the market is currently discounting this stimulus package. It probably would, I can't tell whether it's fully discounted or not, but I think it's discounting the good news, including the stimulus package. And that's why when you see this stimulus package being put through Congress, the Senate, the market tends to cheer it and not ignore it. So basically, we're in this period of time whereby the bad news has been fully discounted, the good news is being discounted. Maybe there's something within the stimulus package which is really exciting, so market then discounts it. So every piece of good news is taken positively now by the market. Every piece of bad news may not be taken negatively because it's already been discounted. So, you know, as the figures get really bad in the US, I think, while unfortunately from a social perspective is of course unfortunate, but I don't think the market will be very surprised because the market's factored that in. Wow, tricky question. You think the Sing government will lock down like any other country? You know, the Singapore government is just handled this thing just brilliantly, I have to say, because it's managed to lock down the country externally without you realizing it, or without us realizing it. So it didn't come out to announce that we're locking down Singapore and not allowing people to come in. So basically, it was taken in a very measured way. And then the announcement came out, social visit passes will not be, people coming for social visit will not be allowed to come in. That effectively is a total lockdown from the external perspective. And people just didn't realize it because, because it wasn't announced like we are going to lock everybody and not allow foreigners in. So the way Singapore has done it has been very subtle, very measured. So I think full marks to that. Then in terms of what we call internal lockdown, they've mentioned circuit breakers, the 2 circuit breakers which will be introduced, and I think potentially it could be, given the way we are actually growing in terms of the numbers of people infected, both imported and also locally, communicated locally. I think the 2 measures will be closing of schools and for people who are non-essential to work from home. So it will again not be mentioned you must stay in your homes for 14 days. But by virtue of saying things like schools are going to be closed, non-essential personnel don't go to work, you stay at home, okay, that effectively is a lockdown. Okay, so a de facto lockdown would occur because of that. So I think they've more or less moved towards a they're moving towards a full lockdown, but they've handled it really well. Sorry, I'm just trying to catch up on the questions. Hang on. With the US being so highly indebted, can they afford, do you think China economy will pick up faster than the rest of the world? Okay, both China and US are highly indebted. One thing the US will, because right now the countries don't care. They're just going to come out with fiscal policies. Debt to GDP is going to shoot through the roof, and they don't care because there's more important things to do, which is, i.e., to try and save the economy. But I think after the dust settles, the markets will look at individual countries and will reward countries who have better fiscal positions than countries who don't. So countries like Singapore, I mean, Singapore comes up with this huge package, starts paying salaries for workers, and I don't think it's going to be penalized by markets. Why? Because Singapore is a net creditor country. Singapore has the reserves to do it, has the money to do it. Any other country who does this, while it may be supportive of the market temporarily, when the dust settles, people are going to scratch their head and they're going to say, how is this country going to pay for this? When this country issues its next tranche of bonds, i.e. government bonds, I'm going to charge it higher interest rates because this country now, the debt to GDP has crossed about 100, 200% of GDP. So the repercussions will come for countries who go on this necessary binge, I would say necessary, fiscal binge, but there will be repercussions. Money is not free. Okay, so but certain countries will do well like Singapore because I think it's a net creditor country, and a few other countries again also. Okay, when you are highly indebted, China, while China economy, I think has restarted back or is restarting back again. One thing we need to be very careful. So it's a very highly leveraged country. So what I expect in the second half of the year is for us to see a lot of defaults. Because why? A lot of packages that are being introduced, it's good enough probably to last April, May, June, July, August, but companies, but governments cannot indefinitely pay salaries and give out free handout for an indefinite period. So there will be, I think, corporate defaults, individual bankruptcies, countries not paying their debts, potentially going ahead. I wouldn't be surprised. So we could, eventually when we settle down and think about what this crisis is all about, it was the banking crisis in 2008. It was the dot-com in 2000. This could actually be a deleveraging crisis because the debt levels, the leverage has just boomed up for the past 10 years. Everybody was so happy taking on leverage. Now, all of a sudden, banks are not giving leverage. Banks are calling back loans. You can't find cash flow because your companies are closed. No one's buying your stuff and things like that. People who are just over-leveraged, companies who are over-leveraged, countries who are over-leveraged are going to pay the price. So I think this is going to be a deleveraging crisis. Okay. Thomas is asking, what's the future of oil price movements? I'm not very in tune with the oil market, Thomas. I have to be very honest with you. I've just seen a report saying that $10 oil price is something which the oil market, and this is from an oil report from an oil magazine. They're talking about $10 oil price. I don't know. I think oil prices itself, I'm not sure, but I do know what the repercussions will be from such low oil prices. The shale markets, the shale industry in the US, which basically is decimated when oil price goes so low, because shale needs oil price to be high in order for in excess of shale's cost of production, in order for people to choose shale over oil. But more importantly is the shale market, or the shale players are players who depend very much on credit, highly leveraged. They issue bonds, they borrow money in order to do their business. With credit markets as it is, with the situation as it is, and prices below the shale production, the shale market is being decimated. So we could get defaults there. How it cascades into other things is left to be seen. But again, I think my knowledge so far on the oil situation is more towards how it could impact the shale side. I think the supplementary budget in Singapore is of course very good. It's being financed very well, but any budgets, any supplementary budgets, any fiscal policy today is basically limited in its effect, because it probably can cover the next couple of months at most. Okay, I think going forward, maybe Singapore has a better financial situation to come out and do another third one, fourth one, without really affecting its overall fiscal position, because it is, after all, like I mentioned, a net creditor country, not like many other countries which are net debtors and stuff. Even if you look into the Singapore numbers, the debt to GDP is effectively net debt to GDP is not very high. You know, the official numbers look very high because and I won't go into it because there's some bond issuances to the CPF and so on and so forth. But truly speaking, Singapore is net creditor in terms. Yeah, so I think the supplementary budget will help the Singapore economy and many of the companies through these 2-3 months. But as long as the world doesn't improve, Singapore is such an open economy, it really depends on everybody else improving before it can truly say that it's out of the woods. So again, supplementary budget is good on the micro level, macro level. There needs to be improvement in order for Singapore to actually get out of this situation. You mentioned the bottom may be over, but yet markets may be underestimating the COVID situation. This rather confusing. Okay. I mentioned, sorry, if I didn't mention the word temporary, I should have. What I see is temporary bottom, because I think the market has discounted the bad news, is discounting the good news, so that is causing the temporary bottom. But going into the second half of the year, I think market has yet to discount all those other things I mentioned, and then we could see another leg down. So that's what I'm trying to explain here. Okay. You mean any further bad news? The STI for this time is nowhere near 08 crisis. Well, actually, I think in 08, most markets fell about 50%. Currently, we're down to about 30%. I read a report that says that normal recessions, you see market, and this is really general, normal recessions, you see market dropping by about 30. More severe recessions, about 40. Big crisis is about 50. So basically, if you look back in the 08 and also the 2000 crisis, you will see that markets actually fell roughly about 50%. So if this warps into a full crisis, which there is a potential it could be, don't be surprised if that 30% goes to 50%. So another 20, not to say another 20% more, but it's 20% more. Okay. Sorry, with the extended lockdown in Malaysia and its economic impact, are your thoughts on the recovery in Malaysia? I'm not. Before that, just let me explain. We have people calling in or coming in from both Malaysia and Singapore. Welcome for our clients and consultants in Malaysia. So there'll be some Malaysian-centric questions and some Singapore-centric questions. I think Malaysia is in a situation which is quite dire, not only from the lockdown, but from the fiscal perspective. The previous budget, Malaysia actually penned in an assumption of, I think, oil prices at about $70 per barrel, if I'm not wrong, if I remember correctly. If oil prices don't pick up, means to say you have a huge gap, shortfall in terms of what you assume in your budget as revenue and what you are getting today in terms of revenue. That is a big thing. So I won't be surprised. I've done ratings before. I won't be surprised if the rating agencies come out and start putting on some pressure onto the ratings by issuing negative, what we call negative watch or outlook. But they won't do it so soon. They'll allow the situation to actually pan out first to see really what's going to happen. If oil prices really don't rise back quick enough, then we could have a situation like what I mentioned. Okay. What's the impact of Fed ETF buying on the financial markets? The Fed ETF buying is concentrated on the bond side. The ETF so far is not on, I don't believe it's on the equity side. What I understand is on the bond. You see, what happened is basically the bond markets and the equity markets are two different animals when it comes to liquidity. The equity markets are very liquid. At any point in time you go in, you want to sell, there is probably a buyer there, except that the buyer may be 5 bits, 6 bits below. Okay, there's someone waiting down there to buy your equity, but maybe 5% lower than what you wanted to sell it at. But the bond market is slightly different because the bond market tends to be more institutional, more big chunk. Every single bond itself is $1 million. So basically what you have is that you could have a situation where the institutions don't want to buy because they just don't dare to buy, or they just say, no, I'm not going to buy. And you don't find a bid. And ETFs are causing a lot of problems also because, again, ETFs has brought in a lot of retail players into the bond market. So when someone sells an ETF, the ETF turns around and tries to sell these things into the bond market. And you have so much selling that no one's buying, again, because like I mentioned, it's mainly institutional buyers there. Unless you have an ETF buying, no one's there. And that is the hard part of the freezing of the market. And that's why the Federal Reserve has to come in to be a buyer of bond ETFs. Otherwise, there's no one there to buy. Okay. Or will you advise those investors who have lost money to do over the next few months? How should they position themselves? The $1 million question. Thanks for the question, JK. Okay. For investors who are that, okay, you mentioned the word investor, so I'm assuming you are someone who is in for the long term. We have people who are traders. They say they're investors, but you know, they tend to want to go in 100%, go out 100%. If you do that, you're a trader. If you're an investor, basically, you will ride through the cycles, but you could do two things. If you are an investor who believes in passive investing, and this has caught on over the past couple of years, passive investing. You know, if you told yourself before, I'm in because I'm a passive investor, I'm buying ETFs, you know, so basically passive means you just hang on. Whatever you've invested in, your belief is in 5, 10, 15, 20 years time, when my financial objective reaches a point where I've already set, for example, I'm in here for 20 years because my retirement is in 20 years. I think that no fund manager can outperform. So I'll just keep this particular allocation, and in 20 years time it will give me back it will give me the so-called return that I want. So in theory, you're not supposed to do anything now because you're a passive investor. So you hang on, you write it down, because economies are cycle. It will come out sooner or later, and then you write it up again, and then you write it down again. So point B, the point in that future is going to be higher than point A. That's almost guaranteed because of, you know, historically, statistically, that's proven. Okay, it's just that as a passive investor, you ride the roller coaster ride all the way lah. Yeah. So if you're a passive investor, you ought not to be doing anything. If you are an active investor, meaning to say you are now saying, I'm paying you, Mr. Fund Manager, I'm paying you, maybe even Mr. Consultant, to try and help me do things in order for me to ride through the cycle, but in a manner which is more comfortable. That's where active comes in. That's where the fund manager, when he sees risk, he puts more in cash. So he doesn't have to be fully invested 100%. He'll have like 10% cash. That's where people like us, when we see risk, will say that, no, it's most aggressive investor, instead of 100% equities, let's put 60% equities. Let's have 40%, which is currently our position. Our most aggressive portfolio has 60% equities, 40% bond. Yeah. So what we do is we don't try and get out of the market totally. We try and lower the volatility. In order for example, currently, if I'm 60-40, the market comes down, this portfolio will still come down, but it's not going to come down as much as the markets. When I think the markets are near to the bottom, I will then redeploy the 40% back into the 60%, creating 100% equity markets in order to ride this cycle, up again. The passive guys will say to me, I don't think you can time the market, so fine, no problem, stay with passive. But if you think that you want to lower the volatility, then you stay with active. So when you are an investor, you don't go out of the markets, which I see a lot of people doing now. So that's a bit confusing, because if you've entered the market as a long-term investor, by right, you shouldn't be going in and out, in and out, in and out 100%, because that's characteristics of a trader, not someone in for the long term. Do you still view gold as a safe haven? Yes, I have a video on that, so I won't elaborate on that. Please go to the YouTube video. I think it's one of the most viewed video. I do believe that gold has fallen because of technical reasons, but the true, real, fundamental reasons for gold going higher is still intact. So I'm still very bullish on gold itself. Okay. How do you see Malaysia as a highly indebted? I think I mentioned before. Because of the indebtedness, because of oil prices coming down, I think the situation in Malaysia is not going to be very pretty. But again, to be fair, many countries in the world are indebted. Many countries in the world have very high level of debt. So it really is going to be quite tricky when we come out of this, because again, we see everywhere. So one of the ideas that I have going into the second half and into the lower and into further out is basically to invest, to get clients to invest in countries where it's less indebted, and countries like Singapore, for example, which I feel, again, net creditor nation, AAA ratings and stuff like that, because in a deleveraging environment, deleveraging crisis, you really want to go for the high quality things, whether it's banks lending to individuals, whether it's investing in corporate bonds, you want to go for the AAAs, whether it's investing in countries, you want to go for the AAAs. So I think countries which are less indebted will benefit, because when the dust settles and the money goes searching around for where to invest, it will go to countries and places where there's less indebtedness. Okay. Will the ringgit depreciate to 4 to 1 Sing dollar? Long term, we know what the trend is. I used to be in, I know when I was young, it was 1 to 1 against Sing dollar, then it went up to 2 to 1, then to 3, now it's about 3 to 1. Going to 4 to 1, I think it's a given, because I won't go into it, it's technical in nature. Singapore strengthens the Sing dollar instead of interest rates. Whenever there's inflation, the Sing dollar is actually guided stronger. And I think inflation, long run, we all know inflation is always there. So the Sing dollar will always be guided in strength, in terms of strength, to a higher level over time. So Sing dollar guaranteed to strengthen over the long run. That's in my view. Okay. The ringgit, unless the ringgit can catch up, which means unless the Malaysian economy can catch up, which also means unless the Malaysian economy can change things like education, can change things like political situation, which I doubt at this point. So I think 4 is a matter of when, not whether. Okay. If China can indeed recover well and quickly from COVID, but not rest of the world, how do you think the situation can pan out? No, the rest of the world will recover. It's just it will go through this really bad situation where the hospitals will become an Italy everywhere. Most places, not everywhere, most places. But that's been discounted by the market. I think I've made my case already. Market's very forward-looking. Market would have discounted that. I don't think, there's one chart I showed you. What if the US loses control of the situation? The worst case scenario is the US doesn't do anything, correct? And that Imperial College epidemic curve shows you the worst case scenario, 2.2 million people dying in the US. So that's already the worst case. The market looks at it, the market says this is the worst case, market digests it, incorporates it and say, okay, fine. I understand the worst case. Is it going to be the worst case? Unlikely. Why? Because they're doing things. Okay, so I think that's part of the discounting mechanism. Quarter closure and quarter reports are about to come out and will hit the market again in coming weeks, along with oil oversupply. Has any of this been considered as an investor? Because Asian region do focus a lot on quarter report. Yes, I think the quarter reports are going to be quite bad, and not only the quarter report, the guidance. That's very important, because a lot of time the quarter reports are a reflection of what's past, or any reports. People look out for the guidance given by the companies or the management, because they can see in the future what, the order books and stuff like that. So I think the guidance is going to be terrible. So I think the market, and I've started to see in the S&P, people mention about S&P markets, people have actually now guided earnings down to negative for the next quarter and stuff. So basically, it's going to be a matching of what's coming out versus what has been predicted, plus what's being guided forward. So I think we could be surprised to the downside from the forward guidance. So don't be surprised if part of the reason why market goes on the next down leg, as I mentioned, is they underestimate the huge impact, which I did mention as point number one. I think the market is also underestimating the repercussions from COVID-19. It's just much more than we think it is. How do you see the Australian economy with the Aussie dollar depreciating so much against other currencies? I'm not an expert on the Australian economy. People keep telling me that the Australian economy is like a province of China. So if China does well, the Australian economy will do well. But I think at the same time, again, my view on China is, while I think the Chinese have managed to grapple with this thing so much better than everybody else, the Chinese economy itself isn't immune from two things. One is a return of COVID-19. They are now starting to receive more imported cases of import COVID-19 cases, because China, unless it closes down its borders, will also start receiving people coming from outside. These people again come from countries which have COVID-19, and the virus is, I mean, how do you detect a virus which remains asymptomatic for up to 10, 14 days? How do you say someone don't enter, my country because you have it? You don't even know the person has it. So because of that, it's going to be very difficult. And I think therefore China, because of that, may also be quite reluctant in terms of people spending and stuff like that. That's number one. And number two, China again is still a country highly dependent on exports, although domestically it depends on imports now, consumer, but it still has an export side to it, which also is going to be decimated. So meaning to say, the only thing that the Chinese are exporting today, and I hear from people on the ground that the ports are being full and there's a queue to go out, are basically medical equipments, masks, ventilators, all heading to Europe, some of them heading to Asia and stuff. But otherwise, other things are still very slow. Okay, one thing you have to understand, the whole supply chain is being affected. One of the things the markets really underestimated, they say that once the Chinese factories come back online, everything is solved. Supply chain goes back again. They forgot that Italy, UK, US, these are also part of the supply chains. So even if you have the Chinese factories coming on board, you have the Italian factories not producing certain parts or certain segments or whatever the case is. You have the UK factories, you have the Eastern European factories, you have the Middle East factories, and so on and so forth. Your supply chain is affected. So again, the whole supply chain is affected. Okay. Should clients go into REITs as part of a portfolio allocation? It's a tricky question, Sama. Very tricky question. I think REITs is something which people really should look at as, because you know why? If you manage to capture a good entry price, then you're basically locking in a very good yield. And that yield is like forever, because if just to give you an example, I've met someone who in Malaysia who bought public bank 20 years ago. And she got in when this public bank share was like really single digit, 1 ringgit, 2 ringgit, 3 ringgit, something like that. And she's been holding on to it. And public bank, of course, for the past 20 years have been paying dividends. So her dividend yield has been incredibly high. So if you capture something and you hold on to it at a low price, then you get a very good yield that you can hang on to for the rest of your life. The only problem with REITs is basically you really have to pick and choose correctly, because we are talking about a situation where, rentals are just going to be very bad. So if someone can, I think we have people who look into this, and I think in the next couple of weeks, we will be really putting out maybe even some recommendations. If you can find one where when the price goes down to a good level, where we think that post-COVID-19, post-vaccine and everything, there's not going to be a change in social norms, i.e. people are still going to go back to shopping centers, rather than I'm so used to shopping online now, everything's online. Okay, so if we can find certain positioning, I think some of these REITs are really good to go in and lock in at a low level, if we can ensure that the rentals will still continue to come in. Okay. sorry, JK. Oh, what would you do with 100,000 cash today? I can't give straightforward advice from a perspective that every client is different. Before I give an advice, I think we need to understand your position. Are you a trader? Are you a long-term investor? What are you going to? How long is your time horizon, and so on and so forth. I can't basically say the answer. But if you were to, and I'm just taking now to say that if you were to speculate in the markets, we did. I'm bullish on gold, and basically that's one thing. But I'm not saying you put everything in gold, because again, that's exceptionally dangerous. But if you're talking about short term, looking for a bit of trading ideas, I have a video on gold, which I think you should look at, and I think that puts forth the argument why I think gold is one particular segment which I feel comfortable to actually recommend. Yeah. So, but if you're looking, I think you should talk to your financial advisor to really get an idea, because you may be talking from the longer term perspective. Okay. Which sectors do you think would survive better through this COVID crisis? Healthcare. No. I mean, pharmaceutical. I mean, these are the guys. If you're in healthcare, you're in pharmaceutical. We have a private equity fund, which is in the UK. What they do is they actually run homes, and they run centers which cater for highly specialized conditions, respiratory conditions and stuff. They have been approached by the British government, and the British government is also renting beds from the private sector, and renting beds from them. So industries like this, who have a direct connection to the situation. Governments are renting beds from them, governments are buying masks from them, governments are asking them to build ventilators or stuff like that. Yeah, those of course will benefit. Short term wise, all other industries, I hesitate to say, because really this thing is just so widespread. It's really very hard to tell, so I won't say. I mean, I'm just confident to say those industries in the healthcare and very specific healthcare. I think those will do well. Yeah. Yes. So the video on Go, please go to Financial Alliance YouTube channel. You'll find that there's a video on Go on the YouTube channel. Just type in Financial Alliance. You'll see our logo there. Go to that channel. All the videos are there. Okay. Okay. Any other last questions? I think we've just crossed an hour. Try and keep it to an hour. We will try and hold this thing actually, every 7 days, 10 days. We'll accumulate some of the news. We'll come and give you. Meanwhile, I'll put out videos for you to see. Do I think Air Asia can survive? Then my question would be: do you think Air Asia can get government support? Because the only airlines that will survive are those airlines that get government support. Otherwise, if you are an independent airline without government support, I really don't know how you're going to survive. I mean, I'm not an aviation expert, but looking at it from a third-party outside perspective, that's the only way. Otherwise, it's going to be extremely difficult. Okay, mind you, I mentioned, who knows, airlines itself may start implementing one seat. Those social distancing, so they will have to, everybody will be seated one seat away. I mean, straight away, that's 50% of your revenue gone, okay, in the future. Will you caution on any investment decision now? What are banks, finance companies going to be doing really bad? Okay, so banks and finance companies, again, it really depends on the banks itself. Have they actually lent out a lot to certain segments of the economy and stuff like that? The good thing about banks now is banks today are different from banks in 2008. Banks today are just so highly capitalized because of Basel II, Basel III, and all the other restrictions. Banks are restricted to do trading and stuff. So banks today are in a much more better position than they were in 2008. So that's a relief. Okay, but of course you will still find some banks who may have lent too much to certain sectors like properties and so on, which are highly leveraged sectors, which if they go down, banks are unable to cover, they're going to have bad debts and stuff. So again, it could be segmentized, but I'm just saying in general, I think banks are well capitalized, and I don't think the issue will arise from bank failures. I think that's not the situation this time around. I think if there's systemic risk will arise this time around from over-leveraged corporations, from over-leveraged individuals, from funds maybe, you know, that kind of thing, who have caught on the wrong side of the market, you know, LTCM, those kind of situation. Yeah, so I think we will see more of those rather than like '08, where it was mainly the banking issue. I don't think that's the issue this time around. Okay, sorry, I have a YouTube video from Sinan. I can't click on it now. I don't know what it is. Yeah, but I'll see it later. Yeah. Any more questions? Otherwise, should we shift EPF into equity investments in Malaysia, or from Dr. Colin? Yes. If you are able to take your CPF or EPF out to invest, of course, what I think now today is, based on my view, that the markets are basically in a temporary bottom. It could go down one more leg. I'm comfortable today to say that if you have money in the market, what you need to do is you need to do a bit of shuffling to push that money into what we call slightly safer investments, to the extent that you're comfortable with. Because as you move, like for example, from equity to bonds, you lower down the volatility of your portfolio. Reach a point whereby you're comfortable, then you just keep it there. Then later on, when the market starts falling, the next down leg, that's when I think people should start moving money in back into the risky assets. Because I think because my view, again, I could be wrong. My view is, in the next down leg, that's when you start moving into risky assets. Now you stay a little bit more on the safe side, safe assets. There are still assets where you can make money. You know, while you think that the whole market is falling, and I have a video on that, there are certain segments of the markets which are still giving you 2, 3%, 4%, and there are really some that gives you 20% and stuff, but of course not for everybody. So there are segments of the market, if you pick and choose correctly, you could still make a decent amount of money. Yeah. So by and large, that would be my view. You could take it out and put it somewhere where it could make some money for you. But if you're sitting in EPF and EPF is giving you 5-6%, that's really a high hurdle. So you could actually put it there temporarily until, like I say, the next down leg, then you start deploying it into equities. Okay. Yeah, Sinan, yes, the Go video, yes, there's a Go video, correct. Very good. For those of you who want to just go straight to the video, someone has posted the link to the Go video. Will tech sector be the next reigning sector in the near future as new work and education condition in emerging online? Yeah, I think the tech sector is an evergreen sector. I mean, it's the brick and mortar sector is the one that's dying everywhere in the world. The tech sector, in fact, now the COVID-19 situation has accelerated what we call the tech sector. You can see how Zoom, for example, which is a software which deals in this kind of thing. GoToMeeting is another one. Zoom has the shares in certain companies which deal in non-face-to-face segment. They're doing very well. So yes, so I think the tech sector, and I think this whole episode will force people to look into certain things. So that's why I'm saying that there could be a change in social norms. Who knows, after this, I'm not saying it will happen, but I won't be surprised if it happened. After this, companies suddenly realize, during the COVID-19 crisis, I've set up all the infrastructure for people to work from home. And guess what? It works. People, of course, at the beginning, productivity is low, but after some time, it actually works. And when I weigh the cost of renting the place, a physical place, and the fact that half my company or even half or 100% of my workers are working from home, versus the rental that I pay for the space and stuff, it actually makes sense for half of those people to stay at home and work. Yeah, it could actually evolve into such a thing, because what started as a crisis could actually become a social norm. So those are the things which I think, that's why when we start saying which companies will do well, it's actually quite hard to actually pick it up until these things really catch on and we get a sense that people come out and the companies start announcing, you know what, from now on, half of our company will be working from home. And then we know it's catching on. Yeah, so I think that's both interesting and also something which is, we don't know what's going to happen. Okay. Yeah, Thomas. Always keep your videos on the half side up. Yeah. The lower part, then everybody say, wow, Sani, you very healthy. gain weight. Okay, the real estate is not doing well too. What do you think? I fear also for, I mean, the thing about the real estate market is the real estate market is one which is highly leveraged. It's all about leverage. It's, you know, you've seen the videos of people saying own 5 properties, own 10 properties. They're pyramiding on all these properties, and of course the boom. Some places like Singapore and I think Malaysia to an extent, and the later part of the boom, they started to come up with measures to limit the amount of properties that one can buy and so on and so forth. So that was good to bring down the bubble a bit. But of course, there's still this leverage effect. So by and large, we saw a lot of assets, and I mentioned this in my wealth forums throughout the years, a lot of assets have gone up. So because of that, that's why I feel this could be a deleveraging crisis, because of a lot of assets will come down. Okay, so we have a situation whereby we are now seeing equities come down. The bond market also is coming down to a certain extent. There's an adjustment, and we are going to see real estate coming down and other things coming down. So we guess there will be a deleveraging effect across all assets. Those that are highly leveraged will see more than those that are not highly leveraged. Okay. So I think we'll keep it as it is now. Thank you very much again for coming to this session. I hope to do it one more time again in the near future, and we'll keep you informed. And meanwhile, please go to our YouTube videos to have a look at it. Thank you once again for coming and joining us, and I hope to see you again. All the best in whatever you're doing, and stay safe. Wash your hands. Thank you. Bye-bye.